When it comes to retirement income planning, everybody wants tax-free money. Well, there's a few accounts out there that'll do it. It could be a Roth 401k, it could be a Roth IRA, maybe some muni bond income. But what if there was one other? What if I told you you could turn your doctor's bills into tax-free retirement income? Let's dive into that today. Hey everybody, Chris Heerlein here, partner at REAP Financial, host of Retire Ready TV on KXAN here in Austin, and host of Wealth Radio on News Radio KLBJ every Saturday, 1 p.m. Thanks for tuning in today. If you liked our channel, please hit the subscribe button, give us a thumbs up down below. Okay, so how do we turn our doctor's bills into tax-free retirement income? It starts by utilizing one of the most underutilized accounts, not just in retirement, but through your working years. If you have a high deductible health insurance plan during your working years, based on today's law, there's a really good chance that you may be eligible to contribute to what's called a health savings account. Now, there's a number of different health accounts out there. There's a flexible savings account and a health savings account, and I want to delineate the two. The one I'm talking about today is the health savings account. Now, why is it so underutilized? Even for families that are qualified to maybe make deposits into one year over year, it's because if you're a young family, maybe you've got a young child, you may tell yourself, hey, I don't have a lot of medical expenses, right? That's down the road in retirement. You may be at a point in your career where if you have a medical expense, prescriptions, doctor's copay, you can pay for that stuff. You self-insure because you've got enough revenue coming in or enough saved. But we all love tax deductions. I know that. And so with a health savings account, you can put a pretty substantial amount into this account each year. And when you put money into it, you get a tax deduction, just like you would on an IRA or a 401k contribution. So it's going to help you save in taxes along the way. Now, here's where people get in trouble. They put money into their HSA and then they forget about it. They just leave it in cash. We don't want you doing that. We want you to make a contribution, get the tax deduction, and then if possible, invest those funds. Now you're putting money in each and every year, and you may have medical expenses along the way. And this is where sometimes families get confused, because I tell you, if you're putting money in it during your working years, you have a medical expense, don't touch it. I don't want you to pull out the debit card or the checkbook on that account. If you're in a position, I would want you to self-insure. Pay for it out of your general checking savings. Why? We want that money cooking and compounding for you through all the years. Now, where it gets interesting is there's over 1,000 qualified medical expenses, HSA medical expenses, that would qualify for this. And it could be things like prescriptions, it could be things like doctor's copays. In fact, when you go to the grocery store next time, one of the major chains, when you look at your balance on the credit card screen, at the very bottom down below, sometimes they delineate a separate balance, and that can be qualified HSA expenses. So what I want you to do is keep track of your medical expenses, starting the day you open it through many years to come, hopefully. And when you have a medical expense you're paying out of pocket, and you're letting this money break a sweat for you through all the years. Then when we get closer to retirement, we are going to be starving for tax-free income. We talk about that a lot on this channel. At this point, you could cut yourself a retroactive reimbursement check for every medical expense you've had through all the years. It could be $10,000, it could be $40,000, $50,000 plus. There's no limit. If you needed the money throughout your working years for anything else, as long as you had documents, receipts to substantiate the withdrawal, it's a bucket of money that can be accessed tax-free even during your working years. Now, a lot of families go, well, Chris, I don't want to just save money for healthcare in 30 years. Well, chances are you'll need it, right, in later life. But get this, a health savings account, once you turn age 65, becomes just like an IRA, an individual retirement account, in which you could pull money out of it for anything you want. It doesn't have to be a qualified medical expense. Now, if it's not a qualified medical expense, it would come out taxable, just like an IRA would. But it gives you flexibility to be able to use those dollars in retirement for your monthly income, for a trip, whatever you need. But this is a really unique strategy that I encourage you to take a look at. In fact, we've got a great report around this. It's called the 4 Tax Buckets, and I want you to get your hands on it. Email me right now, retire@reapfinancial.com. retire at reapfinancial.com, and my team will have it on its way to your inbox. We'll see you next time.